Welcome to the Maybe Not So Great Books channel, You Decide. This lesson 14 of 14. Graham's final lesson, the GEICO Confession, and what it really means from The Intelligent Investor. The definitive book on value investing by Benjamin Graham. Commentary by Jason Zweig.
It's truly a pleasure to be here for the finale. And I mean, what a finale it is.
My father of value investing made more money from one bet that broke all his rules than from 20 years of following them. He admitted it. Nobody talks about it.
No, they don't. It's essentially the open secret of this entire book. I mean, it's the skeleton in the closet of value investing.
Yeah.
And frankly, it is the single most important lesson Graham has to teach us. But you have to read over 600 pages just to find it.
And that is exactly why we are here doing this deep dive. Because we have spent 13 sessions now tearing apart balance sheets.
Right.
Looking at price-to-earnings ratios, talking about Mr. Market, and learning how to be these defensive, boring, disciplined investors.
Very boring.
Exactly. We've preached the gospel of diversification until I'm literally blue in the face. We have preached the gospel of buying cigar butts. You know, companies that are nasty and dirty and cheap, but they have that one good puff left in them.
Which is the classic Graham methodology. It's what everyone associates with the man.
Right. And then we get to the very end of the material, and we find this story about GEICO. And I have to say, when I saw the numbers in the outline for today, I actually stopped reading.
You thought it was a typo.
I did. I thought, okay, the research team made a mistake. They put a comma in the wrong place or something.
It wasn't a mistake. The numbers are incredibly real.
So let's hit the listeners with the raw stats right out of the gate here, because this changes everything we thought we knew about Ben Graham.
Let's do it.
The year is 1948. Benjamin Graham's fund, Graham Newen, buys 50% of a company called GEICO. They pay roughly $712,000 for it.
Which is a pretty significant sum for the time. That's roughly equivalent to maybe $9 or $10 million today. So a big check.
Right. And by 1972, that single purchase was worth approximately $400 million.
Correct. $400 million.
That is a 562-fold return. 562x. That's not a good investment. That's not just beating the market. That is a completely different species of financial event.
It really is. It is the kind of return that venture capitalists dream of now in 2026. If you are a VC on Sand Hill Road and you return 500x on a startup, you are an absolute legend.
Yeah.
And Graham did this with an insurance company in the middle of the 20th century.
But here's the problem. Here's the thing that makes me want to just throw the book across the room. Lovingly, of course, because, it's a classic. But Benjamin Graham is the guy who wrote the rules on safety.
Yes, he is.
He's the guy who said explicitly, do not put more than 5% of your money in any one stock.
That is the first commandment of the defensive investor. Thou shalt diversify.
So surely, for this risky little insurance company, he followed his own rule right.
Right.
How much of the fund did he actually put into GEICO?
He put in roughly 20 to 25% of the fund's total assets.
25%. He broke his own diversification rule by a factor of 5.
He did.
That's not a slight deviation. That's just completely abandoning the strategy.
It's reckless. I mean, if a fund manager did that today, if they took a quarter of the fund and dumped it into a single unproven stock, the compliance department would tackle them before they even hit the buy button.
Absolutely.
But Graham didn't just break the sizing rule, he broke the classification rule too.
Right, because Graham is famous for buying nets. We've talked about this for 13 sessions. Buying companies that are trading for less than their liquidation value.
Yeah.
Basically buying a dollar bill for 50 cents.
Deep value, the bargain bin.
Yeah.
These are companies that are often losing money or have terrible outlooks, but the assets on the books are just so cheap it doesn't even matter.
So was GEICO a bargain bin stock?
Not at all. GEICO was a growth company. Yeah, it was priced based on its future potential earnings power, not just its current pile of cash. It was actually trading at a premium compared to the dead companies Graham usually bought.
So let me get this straight. The father of value investing, the man who wrote the Bible on being safe, being diversified, and never overpaying for growth, he makes a quarter of his fund a bet on a concentrated, high-growth, high-priced insurance company.
That's the reality.
And that one bet accounts for more profit than all his other strategies combined.
That is the paradox right there. If you look at the data from the Financial Analysts Research Foundation and Jason Zweig's commentary, backs this up completely. The GEICO distributions accounted for roughly 92 to 98% of the total value of the Graham-Newman fund over its lifetime.
98%.
Almost all of it. Without GEICO, Benjamin Graham is just a very competent, very smart fund manager who beat the market by a couple of percentage points. With GEICO, he is a god.
This provokes a really uncomfortable question. I want you to think about this as you're listening. If the author of the manual made 90% plus of his money by breaking the rules in the manual, is the book a manual for success?
Right.
Or is it just a manual for staying mediocre while you wait for a winning lottery ticket?
That is the provocative question, isn't it? And honestly, if you are a listener who has been diligently indexing or buying value stocks for years, you should probably feel a little cheated right now.
I feel cheated. It feels like buying a diet book where the author is totally ripped and follows this strict kale regimen, and then on the very last page admits, oh yeah, I also have elite genetics and took steroids for 6 months in 1948.
That is a hilarious but painfully accurate analogy.
So where does he actually admit this? Because I don't remember seeing this in chapter 1.
No, he buries it. It is tucked away in the postscript, the very last section of the book.
Unbelievable.
It's almost like a whisper. You have to read through hundreds of pages of strict discipline, mathematical formulas, warnings about speculation and historical analysis. And then right at the very end, he drops this bomb.
I want to read the quote directly from the text because it is stunningly honest. He writes, ironically enough, the aggregate of profits accruing from this single investment decision far exceeded the sum of all the others realized through 20 years of wide-ranging operations.
Let's unpack that phrase, wide-ranging operations. He's talking about the grind there.
The day-to-day.
Exactly. The thousands of hours reading balance sheets, the endless pondering, the countless individual decisions to buy tiny amounts of boring companies, all that work. Decades of it. It produced less money than this one decision to break the rules in 1948.
It really challenges the entire premise of process. In investing, we love to say, trust the process. If you follow the rules, you will get the result.
Right.
But Graham is admitting that the process basically just kept the lights on. The actual life-changing wealth came from a massive deviation.
And he goes even further in the postscript. He poses a philosophical dilemma that I think keeps a lot of thoughtful investors awake at night.
He asks, one lucky break or one supremely shrewd decision, can we tell them apart? And I have to be honest, that sentence terrifies me.
It should terrify you. It should terrify everyone listening to this deep dive.
Because if Ben Graham, the guy who literally invented the profession of security analysis, can't tell the difference between being a genius and getting lucky, then what chance do I have?
Exactly.
I'm looking at my portfolio thinking, am I smart or is it just a bull market?
That's the nightmare scenario. Imagine you're a surgeon. You perform a surgery, the patient lives, but you have absolutely no idea if it was your brilliant scalpel work or if the patient just had a miraculous immune system. How do you walk into the operating room the next day?
You can't. You'd be totally paralyzed.
And that's what makes this postscript so radical. Graham is effectively admitting that the quote-unquote science of investing might just be a superstitious ritual we perform while we wait for lightning to strike.
But surely he gives us something to hold on to, right? He doesn't just say, hey, it's all luck and sign off.
No, he does offer a lifeline. And I think this is the core concept we really need to teach today. He answers his own question. He says behind the luck or the crucial decision, there must usually exist a background of preparation.
The prepared mind.
Exactly.
Yeah.
Think about it this way. In 1929, Graham almost got completely wiped out. We need to really understand the trauma here. He was using leverage. He was borrowing money to buy stocks. The market crashed and he lost 70% of his fund.
70%? That's not a drawdown. That's a catastrophe.
It was completely life-altering. His wife had to go back to work as a dance teacher just to pay the bills. He considered himself a massive failure. He spent the next 20 years just clawing his way back to break even.
Wow. So the rules, the margin of safety, the diversification, the obsession with cheap assets, those were his trauma response.
Yeah, precisely. They were his survival mechanism. They were designed specifically to keep him in the game. If he hadn't followed those exact rules for the next 20 years, he wouldn't have had the capital or the reputation or even the business still running in 1948 when the GEICO opportunity walked through the door.
So this system, the boring stuff in chapters 1 through 19, it isn't there to make you rich. It's there to stop you from going broke so that you are still standing when luck finally arrives.
You can't get lucky if you're bankrupt.
Right.
The rules buy you time, they buy you longevity. And in the investing game, longevity is really the only way to eventually encounter a fat pitch like GEICO.
Okay, that makes me feel a little less nihilistic about the whole thing. The kale salads keep you alive long enough to win the lottery?
In a way, yes, but we need to look at the lottery ticket itself. Because while Graham calls it luck, when you actually dig into the deal, it looks a lot like genius.
Let's dive into the anatomy of the deal then, because You're right, it wasn't just a random stock pick blindfolded.
No. We need to understand what GEICO actually was. GEICO stands for Government Employees Insurance Company.
Which sounds incredibly boring.
It does. It sounds like the most boring company on earth.
Yeah.
But the business model was revolutionary. In 1948, if you wanted car insurance, you went to an agent. You walked into a physical office, you shook hands with a guy, he took a commission, usually 15 or 20%, and he sold you a policy.
So a big chunk of your premium is just going straight to pay the middleman.
Right. But GEICO said we are going to mail letters directly to government employees.
Why government employees specifically?
Because they're steady, reliable, risk-averse people. They don't drive drunk at 2 in the morning. They file their paperwork on time. They are the ideal insurance customer.
So they cherry-picked the safest drivers and cut out the middleman entirely.
Exactly. And it created a massive structural cost advantage. Their costs were 30 to 40% lower than the competitors. That meant they could lower prices, get more customers, and still make a hefty profit. It's the flywheel effect, decades before Jim Collins ever wrote about it.
So Graham saw this. He looked at the numbers and realized this isn't just an insurance company, this is a compounding machine.
He did. He saw the math. But, and here's the dumb luck part, he almost blew the entire deal.
This is the part of the research that actually made me laugh out loud. The deal was for $712,000. But during the negotiations, there was a dispute.
A very petty dispute. Graham and his partner, Jerome Newman, were haggling with the sellers over how to value some specific insurance liabilities. The gap in price between the buyer and seller was about $50,000.
$50,000? I mean, even in 1948, for a Wall Street investment fund, that's not a monumental amount of money to squabble over when you're buying half a company.
It's the price of a rounding error. But Graham was stubborn. He was a value investor through and through. He didn't want to overpay by a single cent. He notes in the footnotes that the deal nearly fell apart over it. He actually says by dumb luck, they got what they insisted on.
Wait, so if the seller had been just as stubborn over that 50 grand, the history of value investing changes completely. Graham doesn't become a legend. Warren Buffett, who was Graham's student, maybe never buys GEICO later on. Maybe Buffett never becomes the richest man in the world.
The butterfly effect is massive here. If Graham walks away over $50,000, Berkshire Hathaway might not even exist today. At least not in the form we know it.
It really highlights how fragile these legendary track records are. One negotiation goes slightly differently, and we might not be reading this book today.
It does. But there is another twist in this story. A regulatory twist that is honestly even more important than the purchase price.
Right. We touched on this in the intro, but we need to go deep here because this explains why they held it for so long. Graham usually sold stocks when they went up 50% or 100% right.
Correct. His strict discipline was buy low, sell at fair value. Rinse and repeat. Take the base hit and move on.
So why on earth did he hold GEICO for 25 years?
Because he didn't have a choice.
Walk me through this SEC issue, because this feels like the plot twist in a legal drama. Why did the government care if his fund owned an insurance company?
It goes back to the Investment Company Act of 1940. The regulators at the time were terrified of these massive Wall Street investment trusts controlling actual operating businesses. They didn't want Wall Street bankers running Main Street insurance companies. It was very much an antitrust mindset.
Okay, so the SEC looks at Graham Newman and says, you guys own 50% of GEICO. That's a controlling stake. You can't do that. You have to get rid of it.
Essentially, yes. They basically had a regulatory gun to their head. Now, normally, a fund in that situation would just sell the block of stock to another company or dump it on the open market.
Right. Cash out, take the quick profit, and move on to the next net.
But Graham realized two things. One, the tax hit would be massive if they sold. And two, he knew the company was profoundly good. He didn't want to sell. So he devised a distribution scheme. He decided to spin off the shares directly to his investors.
Explain spin-off for someone listening who doesn't work on Wall Street. What actually happens in that process?
Imagine you are an investor in Graham's fund in the late 40s. You put in $10,000. Usually you just get a quarterly report saying your account is now worth $11,000. But with a spin-off, you get a physical letter in the mail. And inside is a paper certificate. It says you now personally own 100 shares of GEICO stock.
So it moves from the fund's pooled account to my own personal brokerage account.
Exactly. And this changed the psychology of the investment completely. If the stock had stayed in the fund, Graham would have sold it eventually to rebalance. He wouldn't have been able to help himself. But once it was in the investor's personal accounts, and crucially in Graham's personal account, inertia took over.
The coffee can effect. You put the stock certificates in a coffee, can put it on the top shelf of the closet and just forget about them.
Yes, and because they forgot about them or they just didn't want to pay the personal capital gains tax to sell them, they rode the rocket ship. They captured the pure compound interest of a massive growth company over 25 straight years.
That is mind-blowing. The greatest value investment in history happened partly because the government forced the greatest value investor to stop trading.
It's the ultimate argument for inactivity. The regulatory constraint saved him from his own strict discipline. If he had followed his sell discipline, he would have missed 90% of the upside. He would have sold the golden goose for the price of a chicken dinner.
So we have dumb luck on the purchase price, and we have government intervention forcing the holding period. It really does make you wonder about that question again. Can we tell luck and shrewdness apart?
It does make it murky. But we have to give credit where it is due. Graham recognized the quality of the underlying business. He deeply understood the combined ratio, which is the math of insurance profitability. He knew that GEICO's costs were structurally lower. He wasn't buying a lottery ticket blindly. He bought a winning ticket. He just didn't realize it was the mega jackpot.
Right, he thought he was buying a solid 2x winner, and it turned out to be a 500x winner. Now, there is a gap in this story that I want to fill in before we move to the modern day.
Yeah.
We talk about 1948 being the buy and 1972 being the peak. But what happened after? Because GEICO didn't just go up in a straight line forever, did it?
Oh, this is a crucial bridge to the modern era, actually. In the mid-1970s, right after Graham died, GEICO almost went bankrupt.
Wait, really? The perfect compounding machine failed.
The management got incredibly arrogant. They stopped being disciplined about who they insured. They started insuring everybody just to grow the top line faster. They completely forgot the government employee part of their own mandate.
Oh, no.
Yeah, losses exploded. The stock crashed from $60 a share all the way down to $2.
It lost 95% of its value.
Yes. It was on the absolute brink of insolvency. And guess who stepped in to save it?
Let me guess. The student.
Warren Buffett. He remembered his teacher's lesson from decades earlier. He remembered how incredibly powerful that low-cost model was if it was run correctly. So he bought massive amounts of the stock when it was bleeding out at $2, eventually buying the whole company.
So the torch was literally passed. Graham found it, wrote it up, died right before it crashed, and then Buffett picked it up from the ashes and built Berkshire Hathaway on top of it.
It's a beautiful, poetic continuity. But it also proves that no business model works on autopilot. You still need rational management.
That brings us to today. We were recording this in early 2026. The world looks very, very different than 1948. You mentioned earlier that nets, those bargain bin companies trading below cash, they don't really exist in the US anymore.
No, markets are way too efficient now. Computers find those mispricings in milliseconds. You can't just open a physical newspaper, run your finger down the column, and find a company trading for less than the cash in its bank account. Hedge funds have algorithms that sniff those out instantly and close the gap.
So if the defensive part of the book, the strict rules, don't work the exact same way, and we can't just stumble into a GEICO by reading a fiscal annual report, how does a listener apply Lesson 14 today?
I think the modern application is what we call the barbell strategy.
Okay, let's unpack this. What does the barbell look like for a normal investor in 2026?
On one end of the barbell, you have extreme safety. Graham used bonds and highly diversified dividend stocks. Today, for most people, that means broad market, low-cost index funds. You put 90% of your money into something boring and highly diversified. That is your survival money.
Okay.
That's the money that keeps you in the game, just like Graham's rules kept him in the game after 1929.
So that's the kale salad part of the portfolio. It just keeps you healthy.
Exactly. It's not exciting, but it works. But then you have the other end of the barbell, the 10%. This is for the enterprising bets. This is where you actively look for your GEICO.
And this 10% isn't diversified.
No. If you diversify your best ideas, you just dilute them. Graham's GEICO win only moved the needle on his wealth because it was 25% of the fund. If he had put 2% into GEICO, it wouldn't have mattered. He would still just be a footnote in financial history.
This is the power law at work.
Right. In venture capital, they know that one single investment will return the entire fund. The other 99 can literally go to zero, and it doesn't matter. If you catch a GEICO or an Amazon or a Bitcoin early, the magnitude of the win is so unbelievably large that it erases all your other losses.
That sounds suspiciously like what people did with Amazon or Apple or even Nvidia over the last couple decades.
It is exactly that. Look at the people who made generational wealth on Amazon. Holding Amazon from, say, 1999 to 2026 violated every single value investing rule in the book. It had a massive PE ratio. It paid zero dividends for most of its life. It was incredibly volatile. It looked expensive the entire time.
Graham would have hated it.
The classic Graham would have hated it. He would have told you to sell it in 2003. But the postscript, Graham, the guy who confessed about GEICO, he would have understood. He would have recognized the massive structural advantage of Amazon's logistics network, or AWS, and he might have said, this is a compounding machine worth breaking the rules for.
So wealth is preserved through diversification, but wealth is created through concentration.
That is the bumper sticker summary of this entire deep dive. You have to know which mode you are currently in. Are you trying to get rich, or you're trying to stay rich? Graham's book is mostly about staying rich. The postscript is the secret hint on how to get rich.
But we have to talk about the danger here, because I can hear a listener right now thinking, great, I'm going to put 25% of my net worth into this new meme coin or this sketchy AI startup because I'm looking for my GEICO.
And that is exactly where we run into the limitation of this lesson, survivorship bias.
Right. For every Benjamin Graham who put 25% into GEICO and became a Wall Street legend, there was a guy who put 25% into Enron, or Bed Bath & Beyond, or some crypto scam that went to absolute zero.
Exactly. Those people don't get to write books called The Intelligent Investor. They disappear from history. We are analyzing the survivor here.
So how do we avoid being the guy who disappears?
We have to go back to that specific quote. Behind the luck, there must usually exist a background of preparation. Graham understood the insurance business deeply. He wasn't just throwing darts. He spent 20 years analyzing businesses before he felt confident enough to make that concentrated bet.
So the limitation is you don't get to skip the journeyman phase. You don't get to skip the 20 years of hard work. If you concentrate your portfolio without that deep background of knowledge, you aren't investing, you're just gambling.
And let's not forget the trauma. We touched on this, but it's vital to really feel it. In 1929, Graham used leverage. He lost 70%.
I just can't imagine the psychological toll of that. Being known as the smartest guy on Wall Street and having to go home and tell your wife she needs to teach dance classes because you lost the family fortune.
It was profoundly humiliating. And it shaped absolutely everything he wrote afterwards. The book is a trauma response. It's a manual on how never to feel that way again.
It's like a guy who survives a horrific car crash and then writes a best-selling book about how to drive 20 miles per hour and always wear a helmet.
Yes. And then right at the very end in the appendix, he admits, but one time I drove 100 miles per hour and it was awesome and I got to my destination in record time.
That is exactly it.
But he only drove 100 miles per hour after he had rebuilt the car himself and knew every single curve of the road perfectly.
This brings us to the debate angle. And this is a really spicy one in the investing world. There is a whole school of thought led by none other than Charlie Munger that suggests Graham was actually, well, maybe not a bad investor, but a deeply flawed one.
Munger was very blunt about this in his later years. He loved Graham as a person, he respected him immensely, but he critiqued his method. He said Graham had a lot to learn and that he was always a little afraid.
Afraid of the 1929 crash happening all over again.
Yes, always looking over his shoulder for the next depression. Munger and Buffett eventually abandoned the cigar butt strategy entirely. They stopped buying bad companies just because they were cheap and moved almost exclusively to the GEICO style, buying great companies at fair prices and holding them forever.
So the question for the listener is this. Is the system, chapters 1 through 19, actually just a way to kill time? Is it just busy work to keep you from doing something stupid while you wait for lightning to strike?
That is the cynical view, definitely. That value investing is basically just a pacifier for adults.
What's the other side of that debate?
The other side is that the system is the only thing that actually works for normal people. Look, Munger and Buffett are generational geniuses. They are absolute outliers. They have massive intellects and the emotional control of a Vulcan. Trying to emulate them directly might be incredibly dangerous for a normal person with a day job.
Because if a normal person tries to, quote-unquote, buy great companies at fair prices, they usually just end up buying hyped companies at insane prices.
Exactly. We see it all the time. So maybe the cigar butt strategy, or its modern equivalent, which is just buying index funds, is actually the superior path for 99% of us. It's the difference between optimization and survival. Munger wants to optimize for maximum wealth generation. Graham, deeply scarred by 1929, wanted to optimize for sheer survival.
And GEICO was the freak accident, where optimizing for survival suddenly turned into maximum wealth.
Yes.
So the real debate is, did he succeed because of his strict rules or in spite of them?
And the evidence of the numbers that massive 562x return, it strongly suggests he succeeded in spite of them.
That is a really tough pill to swallow for the value purists out there.
It is. It really is. But it's the historical truth.
So what does this all mean for Monday morning? We've got this paradox, we have the safety rules that keep us alive, and we have the confession that breaking them is what actually made all the money. What is the practical takeaway for the listener?
I think it comes down to constructing your own personal 90-10 rule.
Walk me through that. What should they do?
Look at your portfolio this week. Are you 100% gambling? Are you all in on speculative tech and crypto? That's way too risky. You're just asking for a 1929 style wipeout.
Right.
But on the flip side, are you 100% diversified in low yield bonds or perfectly safe blue chip stocks? Because if you are, you'll never catch a GEICO, and inflation might just eat you alive slowly over 20 years.
So you need both.
You need both, but they must be kept strictly separate. Designate a mad money pot. Maybe it's 5%, maybe it's 10% of your total capital. This is the money where you are officially allowed to break the rules. You can concentrate it, you can buy high growth, you can buy disruptive technology if you've done the work.
But the key is you have to do the work.
Yes, the thorough analysis that Graham constantly demands. You have to understand the business model, just like Graham understood the math of insurance. You can't just buy a ticker symbol because you saw it trending on social media.
And I think this is the emotional check here. You have to accept that if that 10% goes to absolute zero, your life doesn't change. You still have the 90% keeping you completely safe.
Precisely. That is your modern margin of safety.
And if that 10% pulls a GEICO and goes up 500x over the next 20 years,
then you look like an absolute genius, and you can write a postscript in your own autobiography about how incredibly shrewd you were.
you just pretend it wasn't luck at all.
Exactly. But seriously, the big takeaway is to not confuse a bull market with your own genius. Graham admitted he couldn't tell the difference between luck and shrewdness. If you think you can hoard, you're probably about to lose a lot of money.
Humility is the ultimate margin of safety.
It really is.
It's fascinating to think of Graham at the end of his life. He wasn't living in some massive mansion in New York. He was living in France, translating Greek literature, living relatively modestly. He made this immense fortune, but he seemed almost detached from it.
He was very detached, and I think that's the final beauty of this whole confession. It's a profoundly human moment. He spent a lifetime trying to turn the absolute chaos of the market into a hard science. He wrote the formulas, he defined the strict rules, he tried to tame the beast. And in the very end, he admitted that the biggest part of his success was a beautiful, chaotic, lucky accident.
It makes him less of a marble statue and more of a real human being. And it makes the book, oddly enough, even more valuable because it teaches you how to survive long enough to actually get lucky.
That's the lesson right there. Stay in the game.
That was lesson 14 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.